The UK moves out of recession. Welcome to Market Insight, I'm Ramzan Karamali. GDP over the first 3 months of the year grew by a stronger than expected 0.6%. The UK economy had slipped into a mild recession at the end of 2023 after 2 quarters of negative growth. So does this mean the UK economy has well and truly turned a corner, as the Prime Minister claims? Well, to help answer that and more, I'm joined by Russ Mould, Investment Director at AJ Bell. Russ, thanks so much for joining us. So what's your overall take on today's GDP data? I mean, the FTSE 100 hit yet another record high.
Yeah, it's the FTSE 100's 11th all-time high of the year. And as you say, it likes the data. It hopefully draws a line under that may prove to be a fairly shallow recession. And yet at the same time, you have the bonus of the Bank of England still talking about interest rate cuts perhaps for this year, even if that GDP number was indeed better than expected. And you can see that reflected in not just the headlines, but digging a little bit deeper, interest rate sensitives like house builders, consumer-related stocks, and the miners all seem to be taking it particularly well.
We also had ECB minutes out today, and they showed that policymakers believe Eurozone inflation is on track to ease back to 2% next year. The markets certainly seem buoyed by this, no?
Yeah, I mean, their record at forecasting isn't much better than mine in some ways, but they seem pretty confident that they can get inflation back to its target second half of 2025. And indeed, such is their confidence that 1 or 2 members of the Governing Council have already been voting for an interest rate cut. And there certainly was strong suggestions in the minutes today that that first cut from the ECB will come in June. Hopes were stoked for that by the Swedish cut on Wednesday, which came very quickly after rate cuts in Switzerland, Hungary, and the Czech Republic. So again, Europe seems to be pivoting towards those long-awaited interest cuts, and green screens in Europe today as a result as well.
Now, on the corporate earnings front today, we had better than expected results out of British Airways owner IAG. Air France-KLM and Lufthansa results weren't so hot recently. So what's IAG doing right that the others aren't?
Yeah, I guess AIG is still in the same competitive dogfight that everybody else is, but it's done a brilliant job on its cost base. It's planned its routes very well. It's adding capacity in the right routes. I guess if you're looking to pick holes in those IAG numbers, and the market hasn't really warmed to them too much, people were saying, well, were they flattered by Easter falling into the March? Yes, they're adding capacity, so the load factor hasn't gone up, and business travel isn't picking up perhaps as quickly as they might like as well. So that's possibly why the shares haven't done that well. But I think a lot of it is just down to ruthless focus on balance sheet, ruthless focus on costs.
Now, Russ, how would you assess this current earnings season so far? Would it be fair to say it's been mainly positive?
Yeah, I think it has. I mean, there's been the odd, even some of the stink bombs like Tesla, I think, were largely anticipated, and therefore the shares have actually rallied in the wake of that. Companies are pretty good at managing expectations, and overall, if the global economy, America is continuing to surprise on the upside, it's still remaining strong. No sign of a recession there. Looking at things like weekly unemployment claims, UK coming out of recession, rate cuts may be on the horizon. There may be a little bit more confidence out there, and the natural gas and oil prices are helping on the cost base side. So overall, yeah, good news actually also looks to be good news at the moment, because share prices are taking it positively. They're not worrying about interest rate rises because the economy is running too hot.
Now, looking ahead to next week, we have a slew of results out, and one I know that you've got a close eye on is Burberry. What are you expecting to hear there?
Well, the shares are clearly not expecting anything at all, because I think they're at something like a decade low, and you had a very lukewarm trading statement in November, a profit warning in January, so the base for expectations is already low. I guess the market will be looking to CEO Jonathan Ackroyd to see whether he's still got confidence in his medium-term growth targets and margin targets. I'm not personally that thrilled about a 4 billion revenue target. He could probably get there tomorrow by buying something, but whether that would be a good idea or not remains to be seen. So I'm not sure that's a particularly interesting target. The margin target is more interesting, and they're way below that. And I guess investors were looking for reaffirmation there. And in the nearer term, is China finally cutting them some slack and giving them a bit of benefit rather than the trouble it's giving them in the past 12 months?
Russ Mould from AJ Bell. As always, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.